Welcome back to Inside Options. Joining me as usual is James Boardman from the JSE. And James, where we left off was talking about volatility, and I think you're going to show us a little bit about how volatility plays into this.
We're actually going to look at this graph first. This is a normal distribution, and it's you can see there's the famous bell curve. So a good way to think about that is that the frequency of how often a sort of an event or a sample occurs is on the y-axis, and going across is the size of that move. This is actually for the rand dollar, and the blue one is the top 40 index. Then that's the standard normal is the red. So what it's saying is most of the time not much happens. You can see these events happen very frequently. Then very, very seldom out here we have very wild sort of outcomes. So these are called sort of the fat tails of the distribution. These are the unlikely outcomes. This can be described by the standard deviation. It's the one number, and that is actually implied volatility. It's simply an annualized standard deviation. It means how likely are these fat tails extreme events of either a massive ramp up in a price or a massive decrease in a price. Another way of thinking about it intuitively that is often given is people's heights. For example, most people are sort of clustered around an average height, and there are very, very few people over 7 foot, and there are very few people sort of underneath 4 foot. It becomes very, very rare, the outlying events, and they're clustered around that mean. So that's what the volatility is telling us. How wide is this distribution? Implied volatility is the annual standard deviation. So the higher this number is, the higher the option price will be. Implied volatility is actually the fudge that corrects a lot of the problems of the Black-Scholes model. It's been criticized a lot of times, but by changing that number, you can get any option price you want. The head quant at Bloomberg's once said, implied volatility is the wrong number to put into the wrong model to get the correct answer. And bizarrely enough, despite all these flaws, it's the most popular model, and tweaking that volatility can get us any answer we want. So it's a forecast number, and it's a best guess from current market opinion. So implied volatility is actually set by option prices. It's implied from where option prices are trading in the market. So when we're calculating an implied volatility, all we have to go on is the historical volatility. That's a given number. We can measure it easily. Everyone agrees roughly what it is. But someone described this in terms of using it to forecast as driving 200 k's an hour whilst staring furiously into the rearview mirror.
It is a bizarre way of understanding it, but I guess once you accept that way of thinking, then one understands better how you can get
how
into
option prices sort of come about.
Right.
Is this is this number, and you know that's a big part of what I do on a day-to-day basis, is trying to ensure that these implied volatility numbers we use at the exchange are as fair and accurate as we can possibly make them.
Like reversing your car out the garage.
Exactly.
Yeah.
Carefully with where the park is.
Okay.
Yeah.
Now we're moving on to the spreadsheet.
Yes. Now we're moving on to the spreadsheet. So if we look at the spreadsheet, this is an example I've done of when I first started looking at this particular example. It was on the 19th of April, and that's CFRQ. That's Compagnie Financière Richemont, big luxury goods company. One of South Africa's most famous businessmen is in charge there. That's Johan Rupert, and it was. You could buy a call on that if you thought the luxury goods business was going to do quite well in the near term at a 40 Rand strike. Now, the spot price at that time was a futures price you fill in there is 40.25. We can see our risk-free rate and dividend yield. When you're working with an option on the spot, you need to have those. If you have a good futures price, it already has all the information from the risk-free rate and the dividend yield included in that futures price. So it just makes it quite easy. You have two less fields to fill in. So from the 19th of April to our expiry on the 15th of June, you could buy a 40 Rand call on 100 shares for 190 Rand and 32 cents.
Right.
So because that's on 100 shares, you can see that the price that's important there is the price per share. So you're paying 1 Rand 90 per share for that option to have any upside exposure above the 40 Rand strike. If we look at it a bit later on, we have here, it's a bit small, we can see that that option was valued at 307 Rand 74. So we valued that at the exchange at 308 Rand because we round these premiums to the nearest Rand. The spot price had moved 42.59, so it only moved a tiny bit from the 40.25 previously. We can actually see, I think it was about 5.8% was the move there. So with that 5.8%, that option has changed value by 62%.
Right.
So that is the magic of options trading. You outlaid 190 Rand. That was all you could possibly lose. you've already made 62% of it in a matter of weeks from a 6% move. So that's why options are just absolutely phenomenal for this kind of speculative investing. I mean, some guys traded these on .com stocks and they did incredibly well on these sort of .com stocks.
It also comes back to, as you were saying earlier, doing some fundamental analysis. It's not literally relying on the technical side of things.
Exactly.
You've got to know,
you've got to have a feel, pick the right stock, have an understanding of it, and then be able to do some of the technical stuff in the background. So we can see all these different fields. So here we go. That's the price. The futures price was 40.25, and at that time our option was worth 190 Rand. When the futures price on the 11th of May was 42 Rand 59, the call was worth 308 Rand, 62%. And as I put on the slide there, that's why options are awesome.
All right, James, so options may be awesome, but let's just remind the viewers then of what kinds of tools they have to use.
Absolutely. This example here we've got is actually our spreadsheet, which you can download for free on the JSE's website, jse.co.za/bscalc, C-A-L-C, calc. We can see you can fill in the fields here, and this is exactly how I put in that price. And see on the top here, and on the bottom, we've got this fantastic feature where you can add a deal, and that keeps all the data from above, so we can actually replicate it and do a stress test and see what happens. For example, if the futures price were to be 46 Rand there, you can see that price of the option would have been, on the same day, 623 Rand and 58 cents. So this is very useful in terms of testing out your positions, testing combinations of positions, and getting a value for it.
All right, James, what are we chatting about next week?
Next week we're going to be talking about delta and theta. Now these are option Greeks, and sometimes people get quite intimidated by them.
Another history lesson?
No. We're giving quite a fun analogy. So I'm going to have to check with my bosses about using this analogy, and we'll see. It should be quite fun.
All right, great. Thanks again. And we'll see you again on Inside Options next week. Goodbye.
Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.